Mortgage affordability criteria scrapped. What will happen now? If you've been keeping up with news, you'll have read about this, whether you read it in a paper or online somewhere or on social media or people commenting about it. You'll have read that the FCA is scrapping mortgage affordability criteria. Now, my name's Kevin Wright and I'm going to be sharing exactly what this means. So, stick around. So the scrapping of mortgage affordability criteria sounds pretty scary, doesn't it? Now, I've seen a lot of misinformed comment on this, so I thought I'd just jump on here, do a video and explain exactly what is going on. So the first thing is, it applies to only main residence mortgages. So investors, landlords, you can stand down and breathe easy. It has nothing to do with you. It has nothing to do with you or any of your buy-to-let, HMO, serviced accommodation, holiday let, commercial, semi-commercial mortgages. Good news, but when you want a mortgage for the property you live in, it does apply. So what does scrapping this criteria mean? It's nowhere near as dramatic as it sounds, and let me tell you why. So when you apply for a main resident mortgage, there's a number of hoops that you have to jump through, and all that's happening is they're removing one of the hoops, but the rest of the hoops are still in place. So let's examine all of these hoops one by one and let's see if they're staying or if they're going. So hoop one, multiple of salary or multiple of income if you're not on a salary. The mortgage lenders will not lend you an infinite amount, they'll only lend you a multiple of your salary. Now each mortgage lender has their own view on exactly what multiple they're going to lend, but usually it's in the 4 to 5 times bracket. You might find a lender that will go slightly more than that. You might find a lender that will go slightly less than that. So hoop one is mortgage lenders are only going to lend a multiple of the income that you can prove you earn either by employment or self-employment. That's not changing. Hoop two is commitments. Now, for every loan or credit card or regular payment that you've got, for example, your mobile phone contract, lenders total these up and knock that off your salary. So for example, your salary is £40,000 a year, but you're actually paying £10,000 a year out of that in monthly payments on various credit commitments. So they'll just knock that off and say, well, you earn 40, but actually you're committed already for 10 of it. So we're going to base your multiple of income on 30,000, not 40,000. So hoop two was factoring in your credit commitments, that's staying. Hoop three, lifestyle expenditure. Now lenders realise that whatever your salary or income is not the full picture because there are calls on that money that are different for different people. So take the person on £40,000. Now, you could have one person who's single, no responsibilities, earning a salary of £40,000. But another person on exactly the same £40,000 salary has 3 children to support. So clearly the disposable income is not the same. Even though they earn the same, what they've got to spend on a mortgage is not the same. So hoop three is lifestyle expenditure. And lenders want to know what commitments you've got other than your credit commitments that will eat into your monthly income. So lifestyle expenditure criteria, that's staying. Credit history. Now, they want you to have a good credit history because they like you to prove that you can make your payments on time. So they'll be looking at whatever you have got already, credit cards or loans or that type of stuff, and even things like your overdraft, do you go over your overdraft limit, and all other aspects of your credit history. And they want that to be good or predominantly good. Assessing your credit history, that's staying. Now, one other hoop was what happens if mortgage interest rates jump? Are you still going to be able to afford the mortgage? So what they've been doing is looking at a given rate of interest, adding 3% to that and saying, can you still afford it? Now, that's been one of the hoops for the last few years. Now, this is the one that's going. What do you mean you're not subscribed? Weekly finance videos? Weekly Monday morning Q&As, mentee case studies, what's not to like? Come on, click that button. And that dingy belly thing. And the Instagram one too. That's better. Now back to the video. So they're no longer going to add 3% to the current rate of interest you'd be paying on a mortgage and see if they still think you can afford it. So everything else is staying unaltered, just as it was. That one extra criteria is dropping off. So Armageddon isn't around the corner in terms of mortgage lending. We're not about to go to the Wild West of mortgage lending. We're not going to return to the free and easy days of mortgage lending that was pre-credit crunch. The FCA haven't abandoned all reason, and a lot of the comments I've seen on Facebook posts and the like are over-dramatising the effect of this one factor that's being removed. So I don't believe it's the first step on a slippery slope back to highly irregular mortgage lending. It's a measured step that the FCA think it's appropriate to take to make mortgages a bit more affordable for people. In fact, it's probably a defence mechanism against rising interest rates, because as the base rate is rising, and you've seen in response to rising inflation, we've had base rate increases, something that we haven't seen for a number of years. Now, if the base rate, Bank of England base rate is rising, then mortgage lenders are going to have to increase their mortgages. The mortgage lenders are going to have to increase their mortgage rates too, which means if that extra 3% stayed on, then more people are going to be declined for the level of mortgage they need. So you could say, in a climate of rising inflation, backed up by rising interest rates, leading to rising mortgage rates, it's actually a very sensible move to take out this additional 3% criteria of affordability to ensure the smooth operating of the mortgage market. And that will continue throughout the next 2 or 3 years. Now, possibly they may reintroduce it when inflation and interest rates are back on the decline again. So the message here is, don't panic. Mortgages and mortgage lending is going to stay on an even keel. So that's my message for this week. Nothing to get troubled about, and hopefully that helps you understand and put some context on what you're seeing reported in the news. I'll be back next week with another property finance video. See you then.
If you enjoyed watching this video, did you know every Monday morning at 8:30 I do a live Facebook Q&A. So if you want to start the week with checking out some answers to your property finance questions, click the link here.